So bond buyers, people who loan money to the federal government, well, they turn their backs on the U.S. in some way today. The 30-year Treasury yield going in the wrong direction. I was talking about it. It hit the highest it's been since October of 2023. More than 5% key interest rate. Anything higher than that, well, look at the 10-year. The 10-year is what impacts your mortgage rates. Everything from tech stocks to mortgage rates to issue debt.
There's a supply demand, you know. When there's a lot of debt, it has to be sold, and there is not enough buyers for that debt. And when that happens, bad things happen, like interest rates go up and the economy goes down. So it's you got to get that down to about 3% of GDP.
What is
and
it
now
now?
it's six and a half.
Look, the federal government pays nearly $100 billion with a B per month in just interest on our debt. That's our second biggest expense after Social Security and even higher than our national defense.
Joining us now, Unleash Prosperity Senior Fellow, Heritage Foundation Chief Economist, EJ Antoni. And I was discussing this very topic today, and what blew up yields on the 10-year and the 30-year was a really sour auction for 20-year debt. And it caught everybody off guard, but it shouldn't have, EJ. Are the lenders to the U.S., our bond buyers, are they telling lawmakers, these Republicans, you're not cutting enough?
Dagan, I think that's exactly the right message here. Look, at the end of the day, Congress can vote all they want, but the bond vigilantes get the final vote. And look, the whole question of the supply and demand here that Ray Dalio was just talking about, this is not an issue with the bond salesman. Scott Bessent, our Treasury Secretary, is the best in the business when it comes to sovereign debt markets. It's just simply a matter of the overwhelming supply of Treasury bonds that we're trying to push on markets. You have a 20-year and a 30-year over 5%. You have a 10-year at 4.6, as you can see on the screen there. I mean, these are horrific numbers. To put in perspective how bad it is to see the interest on our debt, these interest rates rather, going to 5%. You know, we already have over 36 trillion. Once they lift the debt ceiling, we're going to hit 37 trillion almost immediately as Treasury replenishes its cash account at the New York Fed. 5% on that is going to be about $1.85 trillion each year just in interest. I mean, that is going to blow all the other expenses out of the water. This is not almost $2 trillion that's going to go to roads or bridges or hospitals or the military or even things like Medicaid or Social Security. This is just interest.
You know, EJ, I won't ask most politicians anything about economics because they know politics, but let me ask you the reverse. What do they need to deliver out of this bill to change this trajectory, to bring those rates back down? And what we're hearing out of them doesn't tell the markets that there's any kind of predictable future in a lot of ways.
David, it's a great question. There's two things that they really need to deliver on with this bill. The first is they absolutely have to get the spending down. And there's a lot of low-hanging fruit there. Repealing all the green, so-called green energy nonsense in the IRA, for example. But there are also a lot of other bad incentives, again, bad government spending that you can repeal from the last 4 years. A lot of boondoggles that have been put in place, but money hasn't actually been spent. Claw that back. Again, it's low-hanging fruit. But the other thing that they have to do is they have to focus the tax cut provisions on the pro-growth agenda. In other words, put in place tax cuts that are going to increase people's incentive to work, to invest, et cetera. Don't waste money on things like SALT, which, yes, I understand you're trying to get votes in terms of the different members of the SALT caucus, but you're not actually providing any kind of incentive to increase economic growth. We need more growth so we can get more revenue and also reduce the spending.
We don't know what the House Freedom Caucus got out of that meeting with the White House, if anything, in cuts that they were demanding. I suspect they just got some fig leaves to cover their bare asses because they walked away with absolutely nothing. I want to move on to this, EJ. President Trump is considering ordering U.S. retirement plans being open to private equity. We're actually in a place right now where private equity is in a shaky place because I know that some of the college endowments are trying to unwind these very illiquid investments. What do you make of this?
Well, at the end of the day, Dagan, I like anything that is going to give consumers more choice, and that includes retirees. I like the idea, again, of giving people access to a more diverse array of financial instruments. I don't like how our tax code, for example, has locked people in to certain kinds of investments. And I also don't like how our current regulatory structure has locked a lot of asset managers into including certain suboptimal investments, again, simply because they have to meet regulatory requirements. Let's get back to a free market agenda where we direct money to where it is most profitable, and we direct savings and investment to where we get the best rate of return, because that helps everybody. Not only do we bring more products and services to market that everybody wants, but savers and retirees get a better return on their investment. It's a win-win.
And EJ, you know what is the least efficient direction of our money? Interest on existing debt. It is the worst place that we could send money.
No argument here.
Great to see you, sir. Thank you for everything, always, your wisdom and sober outlook on what we're facing. Thank you, EJ Antoni.
Thank you for having me.
Yes, sir.
Thanks, EJ.